Good morning. Welcome back here to TM Signals. Great to have you aboard. My name's Jeff Yady. I'll be with you here today talking about NVDA, and not NVIDIA for, hey, it's up big, great, but what are the lessons from NVIDIA that wrap and revolve and apply to the rest of the signals that we get here on TM Signals and how TM Signals is built. TM Signals isn't built on, hey, let's just have the most accurate signals, meaning we're going to be right 80% of the time. It's not built on that. The reason for that is because by the time you add commissions and spreads, you want to be right 80% of the time, and you want to trade directionally. Well, you're getting wrapped up into a lot of other cost expenses, and really to profit from that becomes very difficult. The easiest thing to profit from when it comes to the market are strong trends. Finding those can be a little bit more challenging and doesn't have as much of an accuracy rate, but at the same time can be extremely profitable. And that's what TM Signals is built around. And so let's go take a look here at the signal on NVIDIA and talk about how it's been adjusted, why it's been adjusted, and how it could continue to play out, and then talk about how that applies to some of the current signals and to some of the past signals that have been in play here. On April, I believe it was the 19th, let me grab the data here. Yeah, on the 19th of April, a bull signal was triggered for NVIDIA. Now, this is a bull signal based on the Katie algorithm, okay? This is entirely automated, automatic based on track record, past history of the stock, as well as some of the technical action in the stock. And there's something we can really pull from this entry point with NVIDIA. If you look at this candle action on NVIDIA here that day, it's pretty nondescript. In fact, the stock opened higher than where it closed, meaning the stock actually fell for more of the day than it rose. Pretty nondescript, not a lot to make of it. It's not going to show up on a lot of scanners and top performing stocks and all of that stuff. It's just not. This is very common when it comes to Katie, to have a trigger on a rather nondescript day. Much less common on the Trend Rider, but on Katie, very common to see that. So what happens? Well, here's the data. All right, here's the data, and we've trimmed it down here, but we get a stop that comes into play for NVIDIA. So in this case, 96.75, a target price that comes into play, and a time stop. Okay, so three things. Two of them are based on the price of the stock. One's based on time, meaning that if the stop price or the price target are not hit by the 17th of May, then the signal is deactivated or expires, okay, at whatever the price is at the close on that day. So we have it activated, all right, and what happens? Well, there's a capture price. What is this capture price? Well, this capture price is the first close of NVIDIA above the target price. Okay, this stock was a bullish trigger in this case, so above in this case. And so here we have 3 days later, we have NVIDIA closing above its target price. Now, that doesn't close the signal. And this is where we've had some confusion when it comes to signals. This doesn't close the signal. The target price isn't, oh, well, hey, I'm just expecting it to go there and I'm out. No, the target price actually triggers something else. The target price triggers a new stop, a new target, and a new time stop. So in this case here, the stop was raised to 99.68, the new target 105.54, and in this case, the time stop remained the same. A couple days later, it closes above its next target. So what happened? Well, the stop was adjusted, the target was adjusted, and the time stop was adjusted. Okay. Now, these adjustments are not based on the closing price or on this capture price. Okay. It's not like, oh, well, it triggers and all right, now we have the now we have the stock and it's triggered and off it goes. No, it's based on this original trigger. And this is a key difference between the Katie and TrendRider algorithms and a lot of other technicals out there in the market. When the price or when the stop adjusts here and when the price target adjusts up here, the adjustment is not based on where the stock is at that moment. The adjustment is based off of the opening price of the trigger and how it has moved since that time period. And NVIDIA is a great example of that happening. And we can see why that distinction is very important, okay? But we need to keep in mind that closes, or where the stock closes, determines the actions or triggers the actions, okay? But the adjustment of targets and stops is based on the original signal. And that's a very, we put that into the algorithm. It's something we spent a long time, which do we base off of, which do we measure off of, and it is a very subtle thing, but makes a huge difference. Not when it comes to trades that go against and okay, done, move on, but when it comes to riding the larger trends. Why? Well, it allows for a little bit of a greater volatility. Had the signal been based on this close price here at the end of April, the signal would have stopped out. Okay, the signal would have stopped out a few days later. Great, a win, fine, next. Okay, not bad, right? Not bad. But the chances of riding a bigger trend minimized. So what happens? The stock goes flat for 1, 2, 3, 4, 5, 6, 7, 8, 9 days. In fact, pulls back about $4 off its highs. I mean, that's ouch, right? I mean, 3%. Okay, fine. Then it has earnings. All right, great. Here come earnings. Well, obviously the earnings make the stock hit its price target, right? I mean, it blows through its price target. It just totally blows through it. But what happens here? Notice how every single day for the next 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days, okay, 11 days, the price target and the stops were adjusted. And every single day they were adjusted higher, okay? They were adjusted higher. Even on this big red candle day where the stock was down, what, $10? Somewhere around there, $9, $10 that day. It was a bloodbath. I mean, tech was selling, NVIDIA got hammered. Had the stop been based on this closing price from the day prior, this would have stopped out and been done, which still would have been a great trade, nice, fantastic gain and everything else. But the fact that the adjustments are based on this original trigger allow for greater volatility. And the reason we want to allow for greater volatility is because when you're talking about big gains on a trend, yes, volatility tends to be high. But trends typically don't end like this. Yeah, are the parameters in play to be able to, cash it out if this happens? Absolutely. But that's not how they normally trade. Normally, they're going to have a bad day or two, and then they're going to recover. And then they're going to go to new highs, and they're going to have a bad day or two, and then they're going to recover. And we're seeing that happening, again here with NVIDIA. But the algorithm throughout each one of these days is adjusting the stop and the target on a consistent basis that's not based off of the inconsistency of the price of the stock, but based off consistency off of the original signal. Here's what it looks like, okay? Just take a look at the stop adjustments. right here in category C. Here are the stop adjustments. Can you tell which days the stock was up big or which days the stock was down big? You can't. You can't see it in here. Why? Well, what's going on? There's a consistent growing element to these stops. Almost $3 a day. Okay, almost $3 a day. Same with the target. It's a consistent growing element here. It's not the stock's up $20. Let's now jump the target to $5 above where it closed. No, in fact, for a long time here. So let's go to the 15th and 16th and 17th of May, right? What's the target price? Well, the target price here is 128 on the 18th of May. Okay, 128 on the 18th of May. Well, where's the stock trading? Well, the stock was already trading above its target price all through here. It was already trading above its target price. Yeah, trading above its stop and its target. And that is part of riding the trend. There's nothing in the hitting of the price target that's built into this algorithm that says, hey, when it hits this price target, we take it and move on. If that were the case, our accuracy rate would be way up. But our performance overall would miss some of the biggest profitable moves that can come into stocks. And so you can see how this is adjusted. Once the stock kind of leveled out a little bit, the adjustments caught up. It wasn't adjusting every day. You had to have to adjust after the next big move from 137 to 145. I know that looks small, but $7, that's okay. Then it goes from 142 to 147. Then it gets up here to 160, right? And then the day after, a big bad down day. But the fact that the algorithm was still catching up allowed for this increased volatility here. If you're one that wants to hit tops and bottoms, this isn't a method that's going to work for you. It's going to be frustrating because you're not going to hit tops and bottoms with this. This methodology is designed for one thing and one thing only, and that is to grab trends and to ride the trend for the maximum time possible. Yeah, we could look at volumes and we could throw other things and say, you know what, NVIDIA's probably topped out. In fact, I don't think we see NVIDIA move above 160 anytime soon. But the trend on this, I could be dead wrong. So it's one of those where, okay, great. What's my current stop? What's my current price target? Great. When it closes below my current stop, which is 146.56, okay, 146.56, then I will take it. And you'll notice that's $10 away. That is $10 away, and it has some plenty of leeway in. But as the stock tightens, as the stock just kind of migrates a little bit, that price target or that stop will start to adjust. We'll start to tighten up. We'll start to crank up a little bit. The time element will come into play. If NVIDIA just dances between 152 and 160 for the next 3 weeks, that time stop will come into play and say, hey, all right, signal's over, off we go. Okay, we saw this with Triple D. We saw Triple D essentially on the trend rider evolve in this same fashion. Now, Triple D happened to get a secondary move down that eventually stopped it out and said, okay, this run is, the elements of this run are done. It was a great run. Now, fantastic run and everything else, but the elements of it are done. Did the signal get out at the top? No. Did it get in at the bottom? No. And they're not built for that. But did it climb and capture the majority of this? Absolutely. Okay. Now, one of the trade-offs for doing it this way, for having the algorithm set to perform in this manner, one of the trade-offs is we lose some accuracy because we get some signals that will do some funky things. What do I mean? Well, here's Exxon. Okay, and this was a Katie trigger, and Katie triggers. The trigger part of the algorithm is based on a 3 and 7 day exponential moving average. Okay, and it's based on them crossing. Now, not all 3-7 crosses, trigger a Katie signal, But the signals that come in almost always have that 3-7 cross element. Here's Exxon. Exxon triggered bullish on this day. Okay, went out as a Katie trigger, everything else. The next day, Exxon hit its price target. Okay, hit its price target. Next day drifted lower. The next day pulled back and was stopped out. What happened? What was going on? What was taking place? Well, this is one where had we set it up to take it when it hits its first price target, great, another win. Fantastic, right? But we're looking for a bigger trend. What happens? It hits the stop and it says, hey, that trend's not emerging right here. It's more likely in another spot. Does it ultimately, come back nicely and everything else? Sure, it has. And in fact, this last 3-7 crossover didn't trigger bullish on Katie. The magnitude of this pullback was just a little bit different than some of the others. But, in all here, if you want to up your accuracy rate when it comes to these signals, you can pull them at the first price target or the second price target. The accuracy rate will go up dramatically. But what you'll lose are those bigger trend elements, those more high flyer type of elements that TM Signals is designed to find and is designed to trade with. So bottom line, okay, when it comes down to what do we take from NVIDIA, it's that price action is king, right? It's all about price action. With NVIDIA, how many reversals have there been since the signal? I mean, here it gapped up and went down. Big, bad, bearish engulfing, right? Here it gapped up, went down again. Another day, it gap up, went down. 3 days in a row, gap up and fell. Then the next day, gaps down, doesn't close anywhere close to its high. I mean, on a day-to-day basis, we could start to feel a little anxiety here. Here's this day. Gaps up to 165, runs to 167, and, oh, man, down to 142. Oof. They can be pretty dramatic. Their price action can be pretty dramatic. There can be a lot of stress to that. There's nothing in the algorithm that takes any of that into account. The algorithm's based off the closing price. And what all those other things and oscillations do, we'll let traders and investors futz around with that. Since the NVIDIA signal, okay, back here in April, since the bullish signal, NVIDIA has had 26 analyst comments or changes of either price target, earnings estimates, rating change from overweight to underweight. We had one short seller coming out basically saying, it's the best short play of his life setup. We've had a lot of differing opinions. We've had Goldman Sachs put it on their conviction buy list. We've had all sorts of opinions out there, 26 of them. During this time, we've also had an earnings event. During this time, NVIDIA has also had 2 events, one in San Francisco, one in Los Angeles. Does the algorithm take any of those into account? No. Can they create volatility? Sure. But the algorithm says, look, there is price action here that suggests that this stock could emerge into a really nice trend. It may not. But the probabilities are much higher of NVIDIA emerging into a really nice trend than General Electric, based off of what the price action was, right? Now, General Electric, it emerged into a trend. It happened to be lower, right? And it's not based on the market. It is based off pure price action on that individual stock. The Cadian Trend Rider algorithms, they're automated, they're analytical, they're based on track record, and they're looking for big trends. When it comes to applying trades to them, to apply shares to them, is very easy. It's very simple. Great, market's about to close. Okay, is it near or is it above or below the trigger, price, that close price? That's all you have to look at. So if I look and I go, okay, I have Bank of America, and I own Bank of America stock. Okay, it's up today. What do I do with it? Well, you know what? I can go golfing. I don't have to care. I go to take my daughter to the movies. I can go do something else. I don't have to watch it. Why? Because what's my stop price here on Bank of America? Let me log in and I'll show you here. But I'm nowhere near my stop price. Could Bank of America close below its stop price today? Yeah, it could. But the stop price, the adjusted stop price, $22.97. Okay, $22.97. That's right down here. Okay, nowhere close. Don't have to worry about it. That's the only number I'm concerned with. Yeah, time stop, sure, but that's, time stop here is until the 6th of July, so we're not even close there. So great, fine. I'm going to continue to run with it. And yeah, you know what? There'll be some chop and ebb and some flow and everything else, but this trigger, this crossover of the 3.7 on Bank of America back here at the beginning of June suggested what? It suggested that the price action of the stock is typical of what we tend to see when Bank of America pushes into a big trend. Since then, we've had Fed, we've had bonds go higher, we've had analyst comments, we've had all that kind of stuff. Been great, grand, wonderful. But from a stock trading standpoint, there's only one number I care about. From an option trading standpoint, it can be a little bit different, depending on which options that you have. One of our Trader Minute members played the Under Armour trigger, and Under Armour triggered bullish right here, and the stock went on a nice run, right? Well, the Katie signal didn't close out until late last week, and it didn't close out anywhere near the high. It closed out down here, okay, down here near this low, or down here near this kind of 21 area. Still a 10% gain on the stock. Was still a fantastic, move, right? But nowhere near the high. But from an option basis, had you bought a call option here and you're still holding a call option today, depending on which option you bought, you may be negative, right? So what do you do? What happens? Well, when you start to hit price targets on Under Armour or on any stock that's trending, something happens, right? Your option, okay, especially if you're dealing with short-term calls, your option by this day does what? I mean, stock's up $1.50. What's your option done? It's more than doubled, right? It's more than doubled. So what's happened to your exposure? With the stock, your exposure hasn't changed all that much, but with an option, your exposure has changed dramatically. So one of the things you can do with an option is as it hits targets, you can peel off contracts. So you can still keep exposure, still dollar amount exposure and ride that trend, but you can just peel off contracts as it hits each target level. One of the things that I had mentioned on Trader Minute is, hey, at this point, your option has done a lot, 300, 400%. That's a lot different than what you put in on the trade. And it's something that could go away very quickly. So what do? You pull it. You take it off. You move on. And you do what? If you still want to be an Under Armour, you go buy some 23s. You go buy some out-of-the-money options. Only put what you're willing to lose on it. Take this gain. Let's say your gain was $4,000. You're only willing to lose 500 of that. Take your 4,000 off, throw 500 into the 23, and now if Under Armour just keeps on going, you're making great money, but yet do you have the same risk factor? Not at all. Okay, so when it comes to applying options here, it's a little bit different than applying the stock, and it comes down to exposure levels. With a stock, when your stock price is going up, it needs to go up a lot for your exposure to change. NVDA has done that, okay? But with an option, you don't need a big move for your exposure to change. Hitting just the first price target, hitting the second price target can change your exposure in a dramatic way. And so from a stock standpoint, hit your price target, yawn, snooze, who cares? Option standpoint, hit your price target, you need to address your exposure. What's my exposure? Do I want to change or shift my exposure with a different option? Hope that helped to understand a little bit more into what and how the Cadian Trend Rider triggers move and how their signals change price targets, stops, and time stops here, and how the closing price is the trigger for action, while the trigger price is what stops and price targets are ultimately based on. It's automated, it's analytical, it's based on track records, and most importantly, it's looking for emerging trends. And that makes for a great trading tool going forward as long as there's a disciplined approach with it. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.